Most traders don't fail because they lack technical knowledge. They fail because when the market applies pressure, their decisions fall apart. Charts may look the same, but the way a trader reacts to fear, greed, hesitation, and overconfidence changes everything. And until those reactions are under control, no setup in the world will play out the way it should. That's the untold truth about trading psychology. It's not the flashy part of trading, but it's the one thing that determines whether any strategy can actually succeed. This video is designed to be more than just something you watch once. It's a reset button, something to come back to before a session, after a tough day, or even during live trading to regain focus and discipline. Let it play whenever emotions start to take over, and come back to it whenever you need help with psychology. And once it's finished, move on to the next video in the playlist, letting the lessons build on each other and strengthening the mindset over time. For those who've ever wondered what's holding their trading back, the answer often comes down to a strategy most traders are missing, and that's exactly what's inside the ultimate trading psychology and secret strategy blueprint. It's not another recycled setup or overcomplicated system. It's a practical, easy-to-follow framework that fills the gaps in most traders' approach, giving clarity, consistency, and confidence to every decision. The kind of strategy that once discovered changes the way trading is done. Subscribe to be chosen for a free copy. Stay tuned until the end of this video for more details, or check the description anytime to explore it. But for now, let this video play whenever you need help improving your psychology, and let's get started because by the end of this video, it will be clear why psychology is the real game changer behind every successful trade.
Most traders believe they fail because they don't know enough about technical indicators, chart patterns, or systems. They think the answer lies in learning more, adding more strategies, or memorizing setups. But the deeper truth is that most traders fail because their minds break under pressure. Charts can look perfect, and strategies may seem flawless, but when fear, greed, impatience, or overconfidence appears in the moment, trades that should be straightforward become disasters. Two traders, same strategy. Imagine two traders, both using the exact same system. They see the same high-probability setup. Trader A executes calmly, follows the rules, and accepts losses or gains as they come. Trader B, however, panics when the price dips slightly, doubts the setup, or moves stops unnecessarily. Weeks later, Trader A is consistently profitable, while Trader B is stuck, jumping between strategies, blaming the market, and repeating the same mistakes over and over. This is the untold truth. Strategies alone are meaningless without the ability to act under pressure. Your mind is the engine of trading. Even the best setups fail if emotions hijack your decision-making. Example in real trading. Picture a trader entering a high-probability Forex trade. Within minutes, the price dips below the entry point. Anxiety sets in. The trader moves their stop-loss or exits prematurely. Moments later, the trade rebounds and hits its target. The strategy itself worked perfectly, but the trader's psychology caused a loss or a smaller than expected gain. This illustrates the enormous gap between knowing a strategy and executing it successfully. Why it happens. The mind is wired to react to immediate threats. A red candle triggers fear, a fast spike triggers greed, and suddenly logical planning disappears. Many traders misinterpret this as the market being unpredictable or rigged, when in reality, it's a reflection of their own reactions. Deep dive into common scenarios. Scenario 1. The hesitation trap. A trader sees a perfect setup but hesitates because a recent trade went against them. Instead of entering calmly, they wait for confirmation and the market moves without them. The hesitation itself becomes a loss. Scenario 2. The panic exit. A trade initially moves against them. Fear pushes them to exit early, missing the eventual profit. Emotion destroyed what should have been a winning trade. Overconfidence. After a string of wins, a trader increases position size or takes trades outside their rules. A single mistake wipes out gains. Overconfidence is as dangerous as fear. Actionable exercises to fix this. Pre-trade reflection. Before entering a trade, ask yourself, am I following my plan or reacting to emotion? Mentally rehearse what you will do if the trade goes against you. Visual rehearsal. Close your eyes and imagine the price moving against you. Practice remaining calm and sticking to your rules. Visualization is a proven method to reduce panic during live trades. Emotional journaling. After each trade, log not just results, but how you felt entering, during, and exiting. Track fear, greed, hesitation, and overconfidence. Over time, patterns emerge and self-awareness grows. Story. One trader spent years looking for the perfect strategy. They added indicators, back-tested setups, watched tutorials, but nothing worked consistently. Frustrated, they started noting emotional reactions alongside trades. Fear after news spikes, overconfidence after consecutive wins, impatience after missing entries. Within a few weeks, they identified patterns in their own behavior and adjusted their mindset before executing trades. Without changing the system, their results transformed, proving that psychology, not strategy, was the missing link. Why repetition matters. Behavior change requires repetition. Watching a video, journaling, or reviewing trades repeatedly is how new habits are built. Letting this section sink in now and revisiting it before sessions gradually trains the mind to respond logically rather than emotionally. Key takeaway. Even perfect strategies fail in the wrong hands. The difference between a consistently profitable trader and a struggling one is the ability to execute under pressure, stay disciplined, and manage emotional reactions. Recognizing that psychology drives results is the first critical step toward mastery. Small daily exercise. For the next week, spend 10 to 15 minutes daily reviewing one trade and specifically focusing on emotional responses. Ask yourself, where did fear, greed, or hesitation impact my decision? Over time, these observations will reduce emotional hijacking and allow you to execute strategies as intended.
The market isn't random. Every spike, dip, or pause you see on a chart is the result of countless human decisions: fear, greed, indecision, and overreaction. Understanding this fact is transformative. Most traders fail to recognize it because they focus only on price, indicators, and patterns. Behind every candlestick is a story of human emotion. Think about this. A sudden move up or down isn't just a number changing. It's thousands of traders reacting in real time, some panicking, some chasing, some hedging, some closing positions. Every candle reflects a complex interaction of human psychology. Example of emotional behavior in the market. A stock gaps down 3% after earnings. Many retail traders panic and sell immediately. Large institutional traders recognize this fear and step in to buy at lower prices. The stock rebounds, trapping panicked sellers. This is a classic scenario of emotional reactions driving short-term price movement. In Forex, during news releases, the first reaction is often dominated by fear and uncertainty. The pair spikes violently in one direction, triggering stops. Then, once the dust settles, the trend often reverses or continues in line with the larger market logic. Traders who react emotionally lose, while those observing behavior patterns gain an edge. Why most traders miss this? Most traders see candlesticks and numbers, not emotion. They view spikes and reversals as unpredictable or manipulation, when in reality, these are natural consequences of human behavior. Recognizing this allows a trader to anticipate moves rather than react blindly. Deep dive into emotional market patterns. Stop hunts at support and resistance. Price briefly dips below a support level, triggers stop losses, then reverses. This is the market testing weak hands, driven by fear. Traders who panic sell are the ones caught, while patient traders gain an edge. Greed-driven breakouts. A rapid move higher triggers FOMO in many traders.
They jump in late, often near exhaustion points, leading to quick reversals. Recognizing this allows traders to avoid traps. News spikes. Economic news creates immediate emotional reactions. Fear and uncertainty dominate, often causing exaggerated moves. Traders who treat this as random lose, while those see it as crowd behavior profit. Actionable exercise number 1. Observe the market for one day and write down every spike and dip you see. Ask, what emotion caused this? Fear? Greed? Hesitation? Overreaction? Actionable exercise number 2. Track your own reactions to market moves. How do you respond when price moves against your trade immediately? Do you panic, adjust stops, or hold calmly? Journaling your reactions will reveal patterns that can be corrected over time. Story to illustrate market behavior. A trader noticed repeated morning spikes in the S&P 500 futures market at 8:30 a.m., which initially caused anxiety. Over several weeks, they logged the events and realized these spikes occurred due to large institutional orders, essentially the collective fear and reaction of other traders. Once recognized, these spikes were no longer triggers for panic. Instead, they became high-probability setups for trades executed calmly and consistently. Key insight. The market is a mirror of human behavior. Every spike, dip, or reversal can be interpreted as a predictable emotional reaction. The ability to read the market as a reflection of human psychology, rather than just numbers, is what separates consistently profitable traders from the rest. Practical framework for applying this knowledge. Identify recurring patterns where crowd psychology dominates. Create a plan for each type of reaction: stop hunts, greed spikes, or panic drops. Before taking trades, ask yourself, am I reacting emotionally or am I using market behavior to my advantage? Reinforcing mindset habit. Let this video or playlist run while reviewing charts or after sessions. By continuously exposing yourself to these lessons, your brain starts to recognize emotional patterns in real time, making reactions more deliberate and less instinctive. Repetition over days and weeks is the key to making psychology and market behavior second nature. Small daily challenge. Pick one security or currency pair. Watch its price over a single session. Record every spike, dip, or reversal, and label the likely emotional cause. By the end of the week, you'll start noticing patterns that give you a mental edge, even before applying your strategy. Tie into strategy. This is where a structured approach like the blueprint comes into play. Understanding market behavior alone isn't enough. The missing piece is a strategy that lets you act consistently in alignment with psychology. By combining observation of emotional market patterns with a structured system, trades become predictable and confident rather than reactive. Traders fail not because the market is unfair, but because they fall into predictable psychological traps. Recognizing these traps is critical because awareness is the first step toward control. Most traders don't even realize they're in these traps until it's too late, and by then, emotional reactions have already destroyed trades. Number 1. FOMO. One of the most common traps is FOMO. You see the market moving, a trade forming, and a surge of anxiety hits. I need to get in before it's too late. FOMO drives impulsive entries, often at the worst possible price, and usually against proper risk management. Example story. A trader spots a breakout in a trending Forex pair. Instead of waiting for confirmation, they enter mid-move. The price immediately retraces, hitting stops. Panic sets in. They exit at a loss. Later, the trend resumes, but by chasing, the trader missed the ideal entry and lost confidence. Actionable exercise. Before entering a trade, pause and ask, am I trading because of opportunity or fear? Use a checklist. Is the trade setup valid? Are you following rules? If not, walk away. Number 2. Overtrading. Another common trap is overtrading. Many traders equate more trades with more opportunities. They think, the market is open, I need to make something happen. The reality is that overtrading reduces quality, increases mistakes, and magnifies emotional fatigue. Example story. A trader starts the day with 3 planned setups. After missing the first, they begin forcing trades. The quality drops, risk increases, and emotional reactions intensify. By the end of the day, gains are wiped out by impulsive, unnecessary trades. Practical tip. Define your maximum daily trades ahead of time. Focus only on high-probability setups that meet all your criteria. Use a trading journal to track trade quality and emotional state. Number 3. Revenge trading. Revenge trading is when a trader experiences a loss and immediately tries to recover it by entering another trade without following the plan. This is often driven by anger or frustration. Example story. A trader loses a position on a stock, then immediately enters another trade, doubling position size. The market moves against them again, increasing losses. This cycle repeats, fueled by emotion rather than logic. Exercise to prevent revenge trading. After any loss, implement a mandatory cooling period before entering another trade. During this period, review the losing trade and note what went wrong emotionally versus technically. Ask yourself, am I trading to recover or am I trading for the right setup? Number 4. Overconfidence. Overconfidence often occurs after a streak of wins. Traders begin bending rules, ignoring stops, and taking unnecessary risks. A single loss can wipe out weeks of gains. Example story. A trader has 3 consecutive winning trades. They start increasing trade size and entering setups that don't fully meet their system. A sudden reversal occurs and the gains disappear. Overconfidence blinded them to risk and discipline. Actionable exercise. After every winning trade, reflect on whether rules were followed. Document every deviation from your plan and its consequences. Set a cap on position size to prevent overconfidence from taking control. Number 5. Emotional recognition and habit formation. The key to overcoming all these traps is self-awareness and habit formation. Most traders know they make mistakes, but failed to create systems to correct them. Awareness alone isn't enough. It must be paired with repeated action until discipline becomes second nature. Exercise for habit formation. Log every trade, including emotional state, fear, greed, hesitation, overconfidence. Weekly review. Identify recurring emotional patterns and design corrective measures. Create mental cues. Plan first, trade second. Wait for confirmation, or emotion check before entry. Number 6. Integrating psychology with strategy. This is where most traders fail. They separate strategy from psychology. The blueprint teaches how to merge them. Understanding your emotional triggers is one step, but having a structured strategy ensures those emotions don't dictate decisions. By combining rules-based execution with emotional awareness, trades become predictable, disciplined, and consistent. Example. A trader notices FOMO spikes of breakouts. The blueprint provides a framework. Only enter breakouts that meet criteria, align with higher time frame trends, and pass an emotional check. The trade is executed calmly, avoiding impulsive mistakes. Number 7. Continuous repetition and reinforcement. Psychological traps can't be eliminated in a day. They require repeated exposure and practice. That's why letting this video play during sessions, reviewing past trades, and revisiting the playlist is essential. Repetition trains the mind to recognize emotional cues and respond logically rather than instinctively. Actionable daily practice. Spend 10 to 15 minutes daily reviewing one emotional reaction during trades. Ask, which trap appeared?
How did it affect execution? Journal and apply adjustments the next day. Key takeaways for Section 3. FOMO, overtrading, revenge trading, and overconfidence are the biggest psychological traps. Awareness alone isn't enough. Actionable steps and structured habits are required. A strategy like the blueprint fills the gap between psychology and execution, helping traders navigate these traps consistently.
Trading is more than just charts, indicators, and setups. The untold truth is that psychology drives every decision and determines whether a strategy actually succeeds. Fear, greed, hesitation, and overconfidence are the invisible forces that can make even the best setups fail. Recognizing these patterns is the first step, but awareness alone isn't enough. By understanding the market as a reflection of human behavior and identifying the psychological traps that sabotage trades, traders can start to regain control. But the real edge comes when that awareness is paired with a structured approach, a strategy that fills the gaps most traders never see. That's exactly what the ultimate trading psychology and secret strategy blueprint offers. It's not another recycled setup or overly complicated system. It's a practical framework that addresses the missing pieces in most traders' approaches, helping bring clarity, consistency, and confidence to every decision. Once discovered, it changes the way trading is done. The key takeaway from this video is simple. Psychology is the foundation of every winning trade. Without it, even the perfect system is powerless. But by combining insight into your emotions, understanding market behavior, and using a strategy that bridges psychology with execution, trades become structured, predictable, and disciplined. Let this video play whenever you need help resetting your mindset, before a trading session, after a tough day, or even while actively trading. Revisit the playlist and move from one video to the next, letting the lessons compound and strengthen your mindset over time. If you haven't yet, check the description to explore the blueprint, or subscribe for a chance to get it free. Think of it as the strategy most traders are missing, the one that finally fills the gaps between knowledge, execution, and psychology. Remember, every successful trader knows that the market doesn't just test strategies, it tests the mind. The difference between consistent winners and struggling traders isn't how many indicators they know, but how well they manage their psychology and execute the right strategy. By applying what you've learned in this video, staying disciplined, and leveraging the missing strategy, you're setting yourself up not just for occasional wins, but for a consistent, confident approach that truly changes the game.